Welcome back, traders and investors. We have Jack Steiman here, former columnist for TheStreet. Jack is president of New York-based Visionary Research Group. Now, this is a consulting advisory firm in stock market analysis and education focusing on the charts. Jack, how you doing today?
I'm doing great. Thanks for having me.
Now, glad to have you on. Now, Dennis and I talk about all the different technical patterns, and sometimes you get analysis paralysis, but you like the MACD, moving average convergence divergence. Can you talk about how you got interested in that and how you use it as a trading tool?
Yeah, I got interested in it many years ago when I was first learning how to do this game, which is still the hardest game in the world, and I'm sure everyone recognizes how difficult that is. So when you have a difficult game, you're trying to find every advantage, and there are a million oscillators out there that people like to use. I found that the MACD gives a great sense of market direction from certain levels on the scale. Of course, I can't exactly show that now. Also, when MACD's cross, there's a positive line, there's a negative line, a fast or slow line on the MACD, and when the positive crosses negative from down below, normally that means a pattern of upside action has begun, and conversely, when you get across from the top stretched oscillator and it starts to cross down, you're usually getting a down move. Now, the key to all this is understanding. It helps you understand when an uptrend is ending, when a downtrend is ending. And as we both know, one of the hardest things to do is to buy when the market's weak or to sell strength. And the MACD, I have found, is the best oscillator to give you that kind of insight.
Okay, and do you look at it, and you can look at it at different time frames, correct?
Yes, you can. I use 12, 26, and 9, but everyone has, that's sort of like an automatic default, 12, 26, and 9, 9 being the histogram. I like to use that. There are people who use all types of numbers. And I will say this, and this is really important. Whatever works for you is what you should do. There is no tried and true way that says this is the only way. There are so many different ways that you can use it. I have found 12, 26, and 9 to be great for me. People can choose whatever they want.
Okay. Do you do anything with point and figure charts?
I don't. And people do use that. I'm one of those old-fashioned guys who looks at a chart, says, okay, this, that, and that, this pattern's here, this type of thing exists, this volume exists, et cetera, et cetera. Here are the moving averages, here are the trend lines, here are the gaps. I find gaps to be the single most important aspect of trading. Trend lines next, and moving averages, that type of thing. Some people like point and figure. I'm sure it works well for them, but as an old fogey of the game, I kind of have what I've used from the beginning, and point and figure is really not one of the things I've used.
Okay, with the moving averages, kind of what I've noticed, and I don't know if this is the same thing with the MACD, but I mean, aren't you getting your signals like kind of like after things happen? Like, are you basing your trades on the closing price and entering the next day, or do you see a crossover during the day and then initiate the trade?
Those are great questions. There's so many things to look at during the day. First of all, moving averages are critical, not only on daily charts, but I believe very heavily in the 60-minute hourly charts. I use the daily chart as the bigger picture focus. I use the short-term 60-minute charts for entry and exit, and I'll compare. In other words, if I like the daily chart, I then say, is the 60-minute viable? Is it overbought? Is it not? Is the RSI too high? Is it not? What are the oscillators looking like? If the oscillators match well with the daily chart, then I'll use that for buy and sell. So what I try to do as the day moves along is simply, do I want to hold the stock or not? Do I want this to be a multi-day trade, a one-day trade? Is to gain insight from the 60-minute chart as to whether a stock is too overbought, too stretched, too oversold, too stretched on that level, and then I'll compare it with the daily chart and make a decision on that. So there's a lot that goes into a decision. It's not just looking at a daily chart. I really love the 60-minute charts for that.
So that's the shortest time frame you go is 60 minutes?
Yes, and because listen, everyone's got a way to play this game. There are a lot of people like those 1, 5, 10, 15, 30-minute charts. I don't, and I'll tell you why. The game is too emotional. And to begin with, just from the nature of this business, it's an emotional game. We all understand that. When you start looking at these very short-term time frame charts, they cause overtrading. And when you overtrade, the emotion of that can cause many bad trades. I believe the best way to trade, if you want to day trade, that's fine. Let the 60-minute chart be your guide for the day. Keep it a little more simple. If you're into that 50, 100 trade type of thing per day, great. I just don't think it's a healthy way to trade. I think it becomes too emotional, and the more emotion you put into the game, the more inappropriate trades you're likely to make.
I mean, for me, I go the shortest time frame I go is like 15 minutes, and I like to keep an eye on that. But I see some of these 1 minute charts, and I get just nervous watching it, and the stock doesn't even go anywhere. They just pop around. So I think that one thing we try and stress on the show too is, with the bots, with the high frequency trading, expanding your time frame is something
Yeah.
very important. I mean, even for a day trader, they used to be, 5, 10, 15 minutes, you could get a good trade. Now you got to be much more patient and, perhaps, take trades off the open and let them mature during the day. So, all right. So you use the MACD, and I assume that you're using candlesticks as opposed to bar chart.
Yes, I use candlestick charts, and yes, that's the way I go.
Okay. And another thing that you like to follow is market sentiment. Now, what is your way to gauge market sentiment?
Well, Schaefer service, I recommend people sign up for that. Schaefer, Schaefer. They do a great job. They basically give, and it's an amazing question to ask me this morning because the numbers just came out. Whenever the bull-bear spread gets over 30%, that's a red flag. Too many bulls to bears, but it's not a sell signal. It's just a red flag. Be aware
What's that measuring
that things
there,
are getting
Jack?
a bit frothy.
That
When
bull
they get
bears?
to 35%, I usually like to call it the double red flag. Now, markets can still rise, and they do, but you have to be cautious not to get overly involved. This is when you avoid people call them momentum stocks. If you don't mind, Joel, I'll call them froth stocks. The stocks that have no right trading where they do, and the stocks that get slaughtered when the markets pull back hard. We know all those stocks. We don't have to mention all of them. We know there's hundreds of them out there. When it gets over 40%, that's a sell signal. Now, the sell signal doesn't necessarily kick in the moment. It requires some type of bad news, something to get it started. But when you're at 40%, guess where we're at this morning? 44.8. The market is on a sell signal on sentiment. It is absolutely at this moment on a strong, not just on a sell signal, but on a strong sell signal. And when markets get on a sell signal over 40%, and the bulls are over 60%, it's 62.2% right now, anything over 60% is just death for the bulls. You need to be really careful where you're putting your money. If you want to stay long, my advice is low PE stocks. Avoid the fraud stocks at all cost. Avoid the higher beta stocks at all cost. The reality of things is the market now is in trouble. Not because anything is bad. We have rates low, and as long as the rates stay low, the bull market will continue on. The Fed is going to make sure that's the Fed's job. What's the job description of the Fed? Keep the stock market up. That's how the economy keeps rolling. But when you're at 44%, 44.8 or 6, whatever I said, it's a very, very dangerous number for the bulls, and getting very active here on the long side, I don't think will give you the best results for the next several weeks or months.
Could you just tell us you gave the numbers, what exactly is that measuring?
Yeah, it's measuring letter writers, the people that everyone follows out there that think the market is going to go a certain direction. They poll 100 or more of these writers, and I've been following this service for years. And their following of this kind of spread has been tremendous at letting you know when things are getting very dangerous. So the letter writers out there, like myself, I'm not included in that list, thankfully, but the big letter writers, the big names out there are too bullish. And when they get too bullish and everyone is in and the froth is running rampant, what happens, Joel? Everyone's in, and then the market falls under its own weight. It needs a catalyst. Doesn't mean it's going to happen today, but you keep things very light. When this bull bear spreads over 40%, it's trouble. it's trouble for the bulls.
Okay. Any other, market sentiment do you follow? I mean, we've had
Yeah.
Joe Gitz on before from Social Market Analytics. Do you follow what's going on in the Twitter sphere and stock twits and kind of do a fade? I know Dennis likes to do that.
I just follow oscillators. I'm an RS guy, stochastics, MACD guy. I'm very quiet. I follow nobody. I don't like to look at anyone else's work. I'm pretty much really quiet. And the reason I do that, Joel, is because the game goes back to what I said earlier on. It's too emotion. It's too much babble. People listening to 20 different people, taking 5 different services. This one says this on CNBC. That one says that on Bloomberg. Too much input. It's like enough is enough. You follow your work, you trust your work, you find a set of oscillators that work over time, and you stick with them and you ignore the public. You ignore everyone out there saying what they say. If you follow certain things that I have followed through the years, I could say, thank God, whatever you want to say. I've had some success. Make terrible mistakes. We all make terrible mistakes. We're all human in the game. It's tough. But I think if you can take your time to find a set of oscillators that work for you, not what anyone else has to say about anything, I think you can do okay. Too much input is not a good thing.
Not a good thing. Okay. Dennis and I were talking about earlier in the week, and this relates to sector rotation and trends. You've had a lot of stocks in different sectors making new 52-week highs, multi-year highs, or all-time highs. Now that kind of bodes well for the overall market if it's not all concentrated in one area, in one particular area. What sectors are you looking at now as potentially undervalued, and what sectors are you looking at as potentially overvalued?
Nothing is undervalued. First of all, there is no sector undervalued right now. The entire market is overvalued. But you see, that is irrelevant because it's not whether the market is overvalued or not. As we know, it's about what people are willing to pay. The Fed is keeping the market up through rates. So everything is getting overvalued simply by the fact that money rotates around to keep the market up because there's nowhere else to put your money. So it's not about undervalued. There's clearly nothing undervalued. There's just forced buying by the Fed, which is fine. If that's the market we're in, that's the market we're in, and we adjust and adapt. That's why the market hasn't fallen hard. Money rotates around because people have nowhere else to put it. So when I look at sectors, we could talk transports, we could talk biotech, violently overvalued right now. Some of these stocks are in the stratosphere of PEs or no PEs, but it's not a function of overvalued or undervalued. It's a function of rates. And as long as rates stay low, the bull market lives, although there will be a couple of violent corrections in here. One is coming pretty soon based on sentiment and froth.
Okay, so this leads into the macro Fed related issues, and Bernanke is fine tuned the economy. He's moved on, passed it on to Janet Yellen here. We have unemployment data coming out tomorrow. I mean, it really looks like we're in a period of low interest rates forever. What's going to make the Fed change their stance?
When the economy turns really healthy, the bull market ends. So when things get good, the market goes down. The Fed wants it such that the economy is okay but not great because that's how the economy stays okay through the stock market. At some point in time, I couldn't tell you when, I'm not an economist, but when you saw the ADP report this morning, I don't know if you saw it, Joel.
Yes, we did.
It was
Yep.
was horrific. It was way under the numbers that were expected. That doesn't mean Friday's jobs report's going to be bad, but if this was a prelude to Friday, market's not going to be happy on Friday. But that's what keeps rates low. An economy that refuses to explode under its own power, no matter what the Fed does with QE and rates and so forth, there's not enough energy to blow the economy up, but that's how long the bull market will last. As long as the economy doesn't do great, but is okay, the bull market will live. The moment the economy gets great, which I don't know when that's going to happen, and rates have to start exploding up, that's when the bull market ends.
Okay, and all this for how does it portend for the gold market here? I mean, it's just falling off the $1,300 level. Do you follow the gold market? And if so,
True. I actually was very fortunate to have called the top on gold. That's out there in the universe. I called it for my service a year or two ago. Whenever the top was near 2000. It's a fear-based trade. As long as the world no longer has to deal with world war problems or major war problems, and the economy is okay, gold has no chance. I still think in the next 15 to 20 years, gold will trade between 3 and 500 a share, 3 and 500. Now that doesn't mean there won't be little cyclical bull markets in between. There will be. But to me, gold is a dead issue for the next 2 decades. It will only trend lower, big picture, not all the time, little bull markets in between, but the trend for gold, the day of gold is over.
Okay. All right. Well, if we got any issues that you want Jack to take a look at in the chat room, please, hop in here and we'll try and get Jack to take a look at them. Just, overall, just I like to talk when I talk to different traders and different investors. How do you approach your trading day? Your preparation, is it before the open? Do you do stuff at night, or you just kind of come in and turn on the charts and let them talk to you?
I look a little bit in the evening. I look a lot in the morning. I spend a lot of time early on looking. But I'll be honest with you, when I look at a market like this, I let things like the bull-bear spread have a great influence on what I'm doing. And so I will say to all my folks, okay, which I've been doing for several months now, we can play the market. We've had a great year, but we cannot do it with the fraud stocks. So let's make that first and foremost on our list. What can we eliminate? Then what's still available to play? And I go from there. And in an environment like this, I will tell my folks, I don't mind being very, very heavily in cash. And if they don't like it, I understand that. If they need to leave, that's okay too. But my job is to protect the people who are around. So I take the whole scope of what's going on around the world, in our market, in the charts, bull-bear spreads, things like that, froth, and I put it in a big package and let's go from there.
Do you keep any black swan puts in your portfolio, or you feel like you're hands on enough to to catch an event like that, or you just never have too much exposure where an event like that could put the hurt to you?
Can't play in that kind of fear. The black swan's been talked about for years. It's never happened. There will be a very nasty correction. I don't believe in options very much for people because I think most people don't know how to play them. And most people get killed playing options. They don't understand the time aspect of it. So I don't believe that people should get involved with options. I think what you should do in a market like this is keep heavy cash.
Okay, we've had Jack Steiman, and he is president of New York-based Visionary Research Group, a consulting advisory firm in stock market and analysis, education. Jack, thanks a lot for coming on. Give us just a straightforward look at the market, and we take some notes here on that market sentiment, and we'll see what that unenjoyment number does to the market on Friday.
Thank you, my friend. Be well.
Okay, we'll talk to you soon.